Financial development refers to the improvement and expansion of financial institutions, markets, and systems that facilitate the efficient allocation of resources and the provision of financial services to individuals, businesses, and governments. This process includes the growth of banking sectors, capital markets, insurance companies, and other financial intermediaries that play a critical role in economic development. A well-developed financial system enhances the mobilization of savings, the allocation of capital, risk management, and the facilitation of trade and investment. Financial development is measured by indicators such as financial depth, the size of financial institutions and markets relative to the economy, access, the ability of individuals and businesses to use financial services, efficiency, the cost of financial services and the effectiveness of financial intermediation, and stability, the resilience of financial institutions and markets to shocks. By improving financial development, countries can foster economic growth, reduce poverty, and increase overall economic stability. Effective regulation, good governance, and robust legal frameworks are essential to ensure that financial development leads to inclusive and sustainable economic progress. Financial development is the process of improving the financial institutions, markets, and infrastructure that support economic activities by providing efficient financial services and facilitating capital flows. This includes the growth and diversification of banking systems, stock markets, bond markets, and other financial intermediaries that enable savings, investments, and risk management. A well-functioning financial system is crucial for economic development as it promotes efficient resource allocation, reduces transaction costs, and provides a platform for innovation and entrepreneurship. Financial development is assessed through various metrics, such as the depth of financial institutions, measured by the size of financial assets relative to GDP, access to financial services, measured by the number of bank branches, ATMs, and credit accounts, efficiency, measured by the cost of financial services and the spread between lending and deposit rates, and stability, measured by the health of financial institutions and the stability of financial markets. Enhancing financial development can lead to higher economic growth, improved income distribution, and greater financial inclusion. Policymakers need to ensure a conducive regulatory environment, strong legal systems, and effective governance to support sustainable financial development. Financial development encompasses the evolution and strengthening of financial institutions, markets, and infrastructure that provide essential services for the economy. This development includes the expansion of banking systems, the growth of capital markets, and the establishment of other financial intermediaries, such as insurance companies and pension funds. A well-developed financial sector is vital for economic growth as it facilitates the mobilization of savings, the allocation of capital to productive investments, and the management of financial risks. Key indicators of financial development include financial depth, the ratio of financial assets to GDP, financial access, the availability and usage of financial services, financial efficiency, the cost and performance of financial services, and financial stability, the robustness of financial institutions and markets. Financial development supports economic development by improving resource allocation, reducing poverty, and promoting economic stability. To achieve these benefits, countries need effective regulatory frameworks, strong institutions, and policies that promote transparency, competition, and innovation in the financial sector. Sustainable financial development requires ongoing efforts to improve financial literacy, enhance regulatory oversight, and ensure that financial services are accessible to all segments of the population. Financial development refers to the progression and improvement of financial systems, including institutions, markets, and infrastructure that support economic activities by providing efficient financial services. This development involves the expansion and deepening of banking systems, capital markets, insurance sectors, and other financial intermediaries that play a crucial role in mobilizing savings, facilitating investments, and managing financial risks. A robust financial system is essential for economic growth, as it enhances resource allocation, reduces transaction costs, and promotes innovation and entrepreneurship. Financial development is measured by various indicators such as financial depth, the size of financial assets relative to GDP, financial access, the availability and usage of financial services, financial efficiency, the cost-effectiveness of financial services, and financial stability, the resilience of financial institutions and markets to economic shocks. Promoting financial development can lead to higher economic growth, improved income distribution, and greater financial inclusion. Effective policies and regulatory frameworks, along with good governance and strong legal systems, are critical to ensuring that financial development translates into sustainable and inclusive economic progress. Financial development involves the enhancement and expansion of financial institutions, markets, and infrastructure that are critical for economic growth and stability. This process includes the growth of banking systems, the deepening of capital markets, and the establishment of other financial intermediaries, such as insurance companies, mutual funds, and pension funds. A well-developed financial system plays a pivotal role in mobilizing savings, channeling investments, managing risks, and facilitating trade. Indicators of financial development include financial depth, the ratio of financial assets to GDP, financial access, the penetration and usage of financial services, financial efficiency, the cost and performance of financial services, and financial stability, the health and resilience of financial institutions and markets. By fostering financial development, countries can achieve higher economic growth, reduce poverty, and enhance overall economic stability. Policymakers must create a favorable regulatory environment, ensure effective governance, and promote financial literacy to support sustainable financial development. Continuous improvements in financial infrastructure, innovation, and access to financial services are essential for achieving long-term economic prosperity and stability. Financial development refers to the ongoing improvement and expansion of financial systems, including institutions, markets, and infrastructure, that facilitate economic activities by providing efficient financial services. This encompasses the growth and diversification of banking sectors, capital markets, insurance industries, and other financial intermediaries that enable savings, investments, and risk management. A strong financial system is crucial for economic growth as it promotes efficient resource allocation, reduces transaction costs, and supports innovation and entrepreneurship. Financial development is measured by indicators such as financial depth, the size of financial assets relative to GDP, financial access, the availability and utilization of financial services, financial efficiency, the cost and performance of financial services, and financial stability, the robustness of financial institutions and markets. Enhancing financial development can lead to increased economic growth, improved income distribution, and greater financial inclusion. To achieve sustainable financial development, countries need effective regulatory frameworks, strong institutions, and policies that foster transparency, competition, and innovation in the financial sector. Promoting financial literacy, enhancing regulatory oversight, and ensuring broad access to financial services are key to supporting long-term economic growth and stability.